My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Mr. Brian Stoffel, who knows Brian Feroldi, who I had on a Twitter space not too long ago. Brian, for those who are not familiar with you, introduce yourself. Who are you? How'd you get involved, interested in markets, and what are you doing currently?
Sure. So my name is Brian Stoffel. Believe it or not, coming out of high school, college, I wanted nothing to do with the finance industry. I was actually trained to be a high school English and psychology teacher, and for 5 years, that's what I did. I was actually middle school writing teacher in inner city Washington, D.C. After 5 years, I was at a charter school that actually had very long hours. If anyone out there is familiar with KIPP schools, that's where I was teaching at one of the first KIPP schools. And my wife and I had this crazy idea that we would just retire from teaching, move to Costa Rica for a year, and figure out what was next. Well, when we did that, we had to roll over our 403Bs, and I didn't have any idea what to do about that. And that's where I found The Motley Fool. I also found that having nothing to do, even in a wonderful place like Costa Rica, having nothing specific to do kind of drove me crazy. So I dove into figuring out what to do with the 403B. And I spent a lot of time on the Motley Fool's boards. And this was, by the way, 13, 14 years ago. And what I brought to it was I was a writing teacher. I spent a lot of time writing. And the Motley Fool basically said, hey, you've got the writing down. We'd love it, if you can come and we can train you on the finance part of things, then this could be like a full-time job for you, and you can do it remotely. So I said, great. We can keep going back to Costa Rica. In fact, we just arrived back. Michael and I had been trying to pick a date for this for a while. We arrived back just 2 days ago from our winter in Costa Rica. And now I still do work for the Motley Fool. I've been with them for 13 years, but Brian Feroldi, myself, and third Brian Withers, and I also do a lot of things on the side. We have a YouTube channel. We've got classes that we run on Maven. We've got a weekly newsletter that goes out. So that I think from 30,000 feet, that's kind of how I got involved in this.
You mentioned the psychology background. What part of psychology were you primarily focused on, and has any of that come into the way that you think about markets?
Well, that's a great question. So when I was studying psychology, it was basically just being able to teach intro to psychology, mostly because that was, you don't get much deeper than that when you're teaching in high school. At the same time, I used that in a lot of different areas. I was an intern speechwriter for the Secretary of Education when I was in college, and the area that interested me the most when it comes to markets and psychology was I noticed that the most successful investors weren't always the ones who had all their T's crossed and their I's dotted. It was more about their psychology, their ability to go through, say, a bear market and learn what needs to be learned, but also not overreact. And my interest in psychology had nothing to do with finance, but the more and more I studied it, the more and more interested I got in it. It's also worth stating I got started at the Fool around the same time Morgan Housel did. Many of you know he's the author of The Psychology of Money. And I think that to me, that's the most fascinating part of what we do. Is it's not necessarily the numbers, it's the psychology of it.
You use a term which I want to focus on for a bit here, which is overreact, right? Because I think if you're going to be a true long-term investor, you want to find those opportunities where there's underreaction and avoid where there's underreaction in terms of the up move and overreaction in terms of the up move as well. How do you think about valuation in the context of psychology and timeframes? I know it's wrapping in a lot of different concepts here, but there's a direct link between how somebody thinks and their time frame, and how somebody views a time frame, and whether they buy or sell based on whatever reason they're looking at.
Sure. So I'll tell a little story about that. When I was at the Motley Fool, I was lucky enough to take part in I wrote a series with David Gardner. And David Gardner is the co-founder of the Motley Fool. He's also the chief, kind of what's called the chief rule breaker. He ran the rule breaker service and the stock advisor service for a number of years. And he has a fantastic track record of publicly picking stocks that have done well. The story that he told me that really stuck with me, because he pays no attention to valuation whatsoever, and the reason that he can do that and still be successful is because he likes to say he will get into a stock before everyone else, and he'll leave a stock later than everyone else as well. And of course, that means that he has a ton of terrible picks to his name. However, the asymmetry of long-term investing tilts in his favor. And what I mean by that is that he picked Tesla in 2012, and he's owned Tesla, the stock, since 2012. And because of that, he can have maybe 50 terrible picks that go to zero, and it still doesn't matter because that one pick balances everything out. Now, that does not work for everyone. But the story that he told me of how he got to that viewpoint is worth telling, which is that back when the Motley Fool was getting started, he and a friend were looking to buy Yahoo. And this is in the 90s. This is when Yahoo was a good stock to own. And they said something, I'm going to make up the numbers, but they said, we'll wait till it gets to $23.50 and then we'll buy it. We love the company, but we want that price. And it got down to about $23.75, and it never got down to $23.50. And then over the next 5 years, it 5-bagged or it 10-bagged. Again, I don't have the exact numbers. And he said, that's when I stepped back and I was like, how silly of me to not get that stock over a matter of 25 cents and leave all of that on the table. Now, again, that does not work out every time, and it definitely doesn't work if you don't have a decades or multi-decades long time frame. But if you do and you can stick to it, that was a really important story that I heard that stuck with me.
Let's define timeframes for the audience of it, because I've heard some of your prior conversations and podcasts, and you view the short term as what most people would consider an eternity. Lay out how you think about different time frames and what people get wrong when they think about short, medium, and long term.
Sure. And I wouldn't say anyone gets short, medium, and long term wrong, but if you don't do what you just did, which is define what short, medium, and long term mean to you, then you can be having a conversation with someone and think that you're talking about the exact same thing. I mean, this happens in my marriage all the time. I think I'm talking to my wife about one thing, and then later on I find out we've been talking about totally different things. Where for me, the short term is anything shorter than 3 years. And the medium term is probably between 3 and 10 years. The long term is 10 years plus. I have a sign, it's actually a 3D printed sign that one of my viewers sent to me, and it's 2046. And the reason it's 2046 is that's the year that I'm going to turn 65. And so when I make decisions about buying or selling, trimming or adding to a position, I try and have in my mind 2046. Where, given what this company is doing today, how is that going to affect where it could be in 2046? And if I think they're doing something that's going to position them well for 2046, we're far enough away that I do look at valuation more now than I have in the past, but I still look at it less than 90% of all investors. And if they're making a move that I think will help them in 2046, then I can add to it or buy it. And if they're making a move that might be really good for them in the short term, but I think is actually hurting them in terms of where they could be in 2046, then I trim or I sell.
I think the dilemma when you have a very long time frame is that you have to think about and consider survivorship bias, right? The likelihood of a company being around that long. So we can argue for stocks for the long run in terms of averages, but you and I both know the components of the Dow Jones Industrial Average today are very different than 50 years ago. Um, how do you have confidence in a company specific story when you've got that long of a time frame? Given that, let's face it, the odds may not favor that even that company exists or may even totally change its entire model.
And that is a totally valid question. And so the thing I would say to that is that the company doesn't necessarily have to still be around in 2046, but I do need to continually be checking it between now and then. Now, does that mean that? So I usually will do a full portfolio review once every 6 months. It's informal, but that's basically what I do. Now, if I'm doing that, does that mean that I'm going to get the maximum amount of gains every time? No, absolutely not. Like, it won't. But I would say my portfolio probably only turns over 5 to 10% per year. Obviously, it varies. But if to me it's become clear that some of the competitive advantages that were really important in the past are waning, then I'll start trimming that position. So if it's not around in 2046, I'm controlling for that. And it's also, Michael, worth pointing out that as I get closer, like once it's 2036, I will start taking a very different approach. The thing is that survivorship bias is an important thing to consider, but it's also, again, the asymmetry of returns in the stock market over the long run is look at the value, the greatest value investor, or the father of value investing, Ben Graham. 95% of his outperformance came from one stock that, according to his rules, you never should have bought, Geico. But he did, and that was 95% of his outperformance. Now, I might have that number off by a little bit, but the gist is still the same. So it's not set it and forget it. It's set it and continually keep tracking it. And with that, I think it sets me up close enough so that I believe it'll get me to where I want to go. It certainly does not optimize for my portfolio's performance, but I'm not looking to optimize for it. I'm looking to do well enough to meet my needs.
You know, it's funny about that Buffett point. I've heard others make that argument. It makes it sound as though, and maybe there's an element of this, that Buffett got to be Buffett also because there was a large degree of luck. I mean, if it's really just one company that made up the bulk of his success, wealth compounding that then followed, um, does the Buffett methodology really matter as opposed to that just happens to be what worked for him? What are your thoughts on that? Because I think this is an interesting aspect of investing, the sort of idea that sometimes you just get lucky and you hit it big based on something which maybe you would never have otherwise bought had you followed particular rules.
So when I got started investing, that's exactly what I thought. Every single investor that did really well, that if you follow them, they have one stock that did really well. And you're like, but if they didn't have that, then they would have been nothing. For instance, I was talking about David Gardner. David Gardner bought Amazon at now a split adjusted, I don't know, 31 cents a share. And he personally, and he's held it ever since. He hasn't sold a single share as far as I know. The thing is, that's how every investor is going to be because of the same thing. It's the same force that I was just talking about, the asymmetry of returns. It's the exact same thing. If you're in the market long enough and you're a long-term investor, that's the Pareto principle on steroids. It'll happen with everyone. And so really what truly actually is the defining characteristic is the ability to hold those great companies over time. Like, really, if you had to boil it down to one thing, it's just the ability to hold. And that is the thing that makes the difference. A little anecdote that I would say, I just read Annie Duke's book, Quit. And the book is primarily about how most people quit too soon and when they should quit early. But there's this part in it that talks about the inverse, where I'm sorry, what people say is, she says, is that people don't quit soon enough, was her main point. But she talks about the inverse, where people quit too soon, and she talks about taxi cab drivers. And she says that what taxi drivers, or Uber or Lyft, you could say now these days, most of the time they go out and they have a set amount that they need to make. And as soon as they make that amount, they call it quits. She said, if you really want to optimize for your time spent, maybe your time spent with your family, your time spent on a hobby, your time spent being able to relax and get rest, what you should really do is on the days where it's really doing well, and some of those are predictable, like if you're in New York City, there's a World Series game, or New Year's, or Halloween. Some of them aren't predictable because a storm comes through and everybody wants a taxi. If you commit to, on the days where you're just doing really well, you're picking up fare after fare after fare after fare after fare, and you just say, you know what, I didn't plan on it, but today I'm going to work an extra 4 hours. And on the days where you're not getting any fares at all, just call it quits. They've done some studies and said you'd actually do much better if you quit earlier on the days where it's not going well, and you're like, you know what, I'm just going to ride this train out on the days where it's going really, really well. If you take that lesson and apply it to investing, that's really the thing that made Ben Graham different. It's the thing that made Buffett different. It's the thing that made David Gardner different. It was the ability to hold those stocks that they had conviction in, even though it was already a 20 bagger or a 100 bagger or 200 bagger.
The holding point is, to your point, the real challenging part, and that goes not just to individual stocks. It goes back to any investment strategy. I've used that line many times on the road. Your ability to stick to a strategy matters more than the strategy itself. It's really hard for people nowadays to do that, right? Because there's so many distractions. There's so much ease with which somebody can buy or sell and overtrade, because there's no we're in a commission free world largely with a lot of brokerage houses. How do you think about removing that temptation, right? So you do it for yourself, but a lot of people that check you out on the writings on Motley Fool or on YouTube with the videos, that's the real problem I think that most investors probably have.
The greatest hidden secret power that I have, because I still write for the Motley Fool, is that I need to clear every trade with the Motley Fool. And to clear a trade, you need to have not talked about the company on one of the Motley Fool's products for 2 days, and then you need to not talk about it for 2 more days. And you need to go through an internal system that says we don't have, like, if one of the Motley Fool services is about to have a trade in that, then it's off limits. You can't do anything. And so there are times where we're able, like, I have to wait so long, and it creates so much friction, and it's so frustrating over the short term. But over the long term, that has saved me so much from either selling out of a stock that just had a bad report, or from buying a company that I got excited about. And then as I had more time to think about it, I was like, you know what? That's not as great as it seemed in the moment. And as an individual investor, you have to set up systems of friction. And that is, as you just said, commission-free trading is great if it's used properly, but it's really hard to use properly.
Yeah, and so I've used that line too. It's like the best thing any investor can do is probably to go for the highest commission broker, right, to increase the
Yes,
friction. But I take it even a step further. Even in the technology world, it's like turn off your push notifications, right? So if you got an
yes.
app for some brokerage account that you've got, and they're sending you some push notification, markets up this or down this, it's like it creates the exact wrong kind of behavior, because first of all, it's all largely randomness and noise. But it creates this feeling that you gotta click in and do something with that information, when in reality you should totally ignore it.
Yes, absolutely. And I think that goes for life as well. It drives my family and friends crazy, but my phone doesn't even ring unless it's my wife. I don't get push notifications. I don't get anything. There are days where I go on YouTube and people are asking about the market on that specific day, and I have no idea what it's done. And um, that might sound like I'm being irresponsible, but the signal to noise ratio is so skewed, and our brains, like, the marketers know exactly how our brains evolved, and they know how to get our attention. The thing is that it's 99.9% noise. And so it feels irresponsible when you start by turning off, for instance, this is the first Twitter Spaces I've ever done because I didn't have the Twitter app. I always, even on my iPhone, I always go on to the actual Twitter website on the internet to go onto Twitter because I don't want that on my phone. So yeah, and sometimes I just think that you got to learn that lesson the hard way and make some mistakes and be like, you know what, this just doesn't work for me. It's time to try something else.
Yeah, I mean, I think as you're talking, it dawned on me. It's engagement is inversely correlated to alpha,
Yes.
right? I think that's that kind of at the core of it, right? Because if something gets a lot of likes or retweets on Twitter, first of all, it's probably meaningless and it's probably just confirmation bias to begin with, which means people are already invested in whatever that idea is, which means it's probably not going to pan out. That's why it becomes so easy. I think it's interesting as we're talking through this, so much easier to be contrarian when you see high engagement on Twitter because that shows you where most people have already placed their bets on, right? Which
Yes.
just kind of an interesting observation. All right, so I want to focus on the concept of anti-fragility. I'm a fan of Nassim Taleb's, even though he countered one of my tweets last year, despite I think he just didn't really understand what I was trying to address with the failure of the flight to safety trade in treasuries. But I'm a big fan of his line of thinking. Talk about why his approach towards anti-fragility is something that you gravitated towards and how you kind of made it your own in your own portfolio.
Sure. So, and the idea of anti-fragility, to explain it from 100,000 feet, is that the world can be divided into three things. The fragile, that breaks really easily under pressure. The robust, it pretty much stays the same over time, chaos, the unexpected, and pressure. And then the anti-fragile, and those are things that get stronger when exposed to time and chaos and pressure. And what made me gravitate towards it was that this was something that said you should go towards chaos and go towards a certain type of stress. And I loved that. And so what I did was I wanted to start looking for companies that were anti-fragile. Now, what I want to explain here, because this is something that a lot of people get confused about on Twitter, is that investing in companies that share traits that, for me, I think of as anti-fragile is not the same thing as constructing an anti-fragile portfolio. And I want to say that again. Investing in companies that share the traits of anti-fragility is not the same thing as constructing a portfolio that's anti-fragile.
Right,
Now,
that's because of the correlation towards extremes in terms of beta, right? I mean, it's the co-movement idea.
right. And so if I wanted to construct a portfolio that was anti-fragile, what I would probably do is have 80% of it in super safe things, and 20% of it in the type of options that would lose a little bit of money every day, but make a ton of money when the unexpected. So when COVID hits, when 9/11 hits, when 2008 hits. So those are two different things. The reason that I don't do the portfolio strategy, there's two. One, I don't have the patience for it, and two, I'm not smart enough to pull it off. I don't I don't get into things that I don't understand, and I have two kids under 10, and I don't like spending all of my time on this, and I would have to spend all my time to teach myself what is necessary to do it. So I take the approach of I invest in companies that share traits of anti-fragility, and my safety net is I live well below my means, and I keep a huge pile of cash sitting around so that I can use it when I want to. That's simplified. It's a dummied down version, but it works for me.
Okay, now let's talk about some of the traits of those companies, and
Sure.
let's also maybe distinguish between anti-fragile companies that are likely to be anti-fragile versus sectors and industries that are likely to be anti-fragile, right? Because presumably there's always a sector industry component to anti-fragility.
So I when I'm looking at individual companies, there's three broad categories I look at. The first is the barbell strategy. Now, the barbell strategy is exactly what I just said, where you have 80% of your resources going to something that's very safe and stable, and 20% going to projects that will probably fail, but if they hit, would be a big deal. And so, what I look for when I look for that is three traits. I look for one, a mission-driven company. So they've got to have a pretty easy to understand mission, and they've got to have proof of all of their efforts going towards that mission. But the big thing I look for there is on the safe side, I look for a business with a moat. And on that risky side, I look for some evidence of optionality. Now, no company that is easy to understand is a better example of this than Amazon. Amazon's mission is to be Earth's most customer-centric company. And if you go back over time, they have consistently had a wide moat in one business and a whole bunch of experiments in that risky area. And then once one of those experiments hits, it slides over onto that wide moat area. So AWS would be an example. If you invested in Amazon back when David Gardner did in the late 90s, AWS had absolutely nothing to do with it. It was one of those high risk, high reward. It's more of a low risk because you're not spending too much on it. A low risk, low probability of success, but high reward that Amazon was testing out. And in 2003, they decided to really commit to it. And as it was successful, it moved on to the more safe and steady part of the barbell. So that's one area that I look for. The second one is financial fortitude, which just means you've got a lot of cash, not too much debt, and you've got tons of free cash flow. Why? Because when tough times hit, whether it's company specific, sector specific, or macro, then you can actually get stronger because you can buy out competitors, you can buy back your own stock on the cheap, or if you want to be really Machiavellian, you can underprice your products to a money losing point so that you drive your competition out of business. So that's the second thing. And then the third thing I look for is much more soft. It's a softer, more psychology variable in nature, which is skin in the game. So I like founder led companies. I like it when insiders own a lot of the stock. And I like it when employees generally enjoy working there. And Glassdoor is a proxy. It's not a perfect proxy, but Glassdoor, the review website for especially tech workers, is the third one. So that's what I think about when I'm looking at it. Now, if you're talking about specific sectors, I spend most of my time in medical devices, software, technology. I think that those tend to be pretty anti-fragile. It's by no means that they're the only ones that are anti-fragile, but there's certainly ones that are super fragile. Airlines, I think, are a great example. And if you want to talk about really being an anti-fragile investor, like biotechnology would be a great one because you might fail 90% of the time, but as long as you spread your bets evenly and you hold your winners throughout, you can still do very, very, very well.
It's interesting you mentioned technology. It seems to me that we're in an era, and I don't know if anything would ever change with this dynamic, where large data is the real moat, right? Because you can really get more efficient as a large tech company, and once you have that data, it's hard for a lot of other companies to get the kind of first mover advantage, obviously, from that. How do you think about large data as a tell for anti fragility?
So the way that I think about large data is actually very similar to how I think about Amazon's lead in delivery. Now that might sound really like an odd thing, but what gave Amazon, if you just throw AWS out, which I know you shouldn't do because it's such an important piece of it, but what makes Amazon so dominant in e-commerce, in my opinion, is that it can offer next day, 2-day delivery for a lower internal cost than just about anyone. Now, why can they do that? Because they've got a fulfillment center located about half an hour from everyone in North America. I'm obviously being hyperbolic, but I think that's a huge advantage that takes a long time for someone to usurp. Now, I think we're starting to see that people are willing to commit the dollars necessary to start putting a serious dent in that moat. It's something that, as an Amazon shareholder, I need to constantly monitor, but I still think it's there. And I think the same effects are at play when it comes to data, that having data and being able to collect that data, to me, the big key is being able to collect it at a lower internal cost. So Google's and Facebook or Meta's key moat is low cost production. But what is it that they produce at a low cost? It's data. Why is it low cost? Because relative to its size, it doesn't cost Meta that much to run Facebook or Instagram relative to its size. And we know that because if Zuckerberg wasn't spending so much on the metaverse right now, they have margins that are previously unheard of. So to me, it's more important to watch the moat that's protecting that low cost production, which is usually network effects. And keeping an eye on that, we're starting to see that social media properties are not immune to being disrupted. TikTok came along pretty quickly and started causing Google to change what they're doing with Reels on YouTube and change what they're doing on Instagram. So it's something you got to keep an eye on. And I thought Google was the company that was doing a better job of this because they're not really reliant on social media at all. They're reliant upon the 9 products with over 1 billion active users that they've got that they can collect data from. And, within the last couple months, we've seen Microsoft and Chat show up and for the first time really offer something that might threaten that. And it's worth saying that moats are not forever, but they're still very important.
Yeah, no question. And but of course, even in the case of TikTok, right, there was a lot of funding behind that. I mean, it takes even more money to unseat the already established, players that have a moat, right, in order to cause them to stand up and take notice. Um, let's talk about the writings for a minute, as far as Motley Fool.
Mm-hmm.
I've written a lot. I used to be one of MarketWatch.com's top writers for several years. And I think people underappreciate how challenging it is to say the same thing 500 different ways. Okay, which is really the key to content, generation and creation. How do you keep yourself motivated to keep pushing content out there? Because you're going to be repeating things, presumably, even if it's different companies. You're going to revisit the companies. Sure, there might be some news related to it to give you something to talk about, but for the most part, a thesis is a thesis.
Yeah. I think what you do is you, over time, realize that you're writing about 2 or 3 core messages, it seems like every day. And you go through this progression where at first you feel kind of like a fraud and you shouldn't be earning any money because you're like, I'm just basically teaching the same 2 or 3 lessons every week. And then as you keep doing it, you realize, no, that is the job, is to find those 2 or 3 messages that are important, that you find to be true. So you put your own skin in the game with it. So, and that's important because there can be 2 or 3 messages that are very popular that are also just wrong. And you don't have your money invested in a way that reflects that you actually believe in that message. But if you can find those 2 or 3 messages, then you just start, what you do is you start looking for it showing up in different places. And as with everything, there's a huge problem with that as well, which is that eventually some evidence might show up to say, hey, this message that you've been teaching actually is starting to apply less and less. And because you're focused on those 2 or 3 lessons and you're looking for examples of it in the world around you, you are, of course, going to suffer from confirmation bias. I think that is the tightrope that you need to walk if you want to do this over the long run is, yes, this has been a core message. I wonder if there's some evidence that I should be changing a little bit. And so to give you an example, for most of the last 8 years, I have said, look, valuation is not part of my process because I am focused on 2046. And over the next 3 years, valuation is the only thing that will make a difference in a company's returns, in their stock returns. But over the multi-decades, I believe that anti-fragility is the only thing that matters in terms of returns because the moat is the defense that keeps the competitors at bay, and optionality or those high-risk bets that a company makes, that's the offense. That's the AWS. For Airbnb, that's the long-term stays and the experiences that are starting to meaningfully add. For software companies like, for instance, Datadog, it's all the new products that they're rolling out that that their customers are actually using. So I didn't pay any attention to valuation. However, and I'll just put my numbers out there, I was down 53% in 2022. 53%. And part of that was because I said, now it's worth noting, I was still beating the market since over the past 10 years, even after that, but not by nearly as much. And it caused me to say, you know what, valuation was 0% of what I talk about. That might have actually made me, I might have wedded myself a little bit too closely to that lesson. And so I started looking at it and making some changes. And that, to me, that's the tightrope that you need to watch if you're creating content in this area is find those 2 or 3 lessons, hammer home on them, but figure out a way to check yourself because 1 or 2 of those is probably going to change during your lifetime. And you don't want to keep hammering home on something that isn't true anymore because if you're investing to match those lessons, you're going to pay a price in your own portfolio as well, just like I did.
By the way, you know who else was down more than 50% is twice in his career at least was Warren Buffett. So, and I
Yeah,
say that, it's always amazing to me how people think about drawdowns because it is unavoidable. No matter what you do, you're going to have a drawdown. And there's this great saying: it's like your biggest drawdown is always yet to come, right? So, but that doesn't necessarily mean that you're down and out. Even if you have a severe loss, you can still come back. And there are plenty of instances where historically the broad stock market itself has a decline that's is that big. And then yeah, sure, it takes years, but it's not the end, right? And it doesn't necessarily tell you anything about the asset class or the individual trading around that asset class. It's always just about cycles and the harsh reality that shit happens in portfolios.
yeah.
Let's
Well,
talk. Go ahead. Go ahead.
well, I was just going to say, and it gets back to I think the most important thing is what you led off the podcast with, which is define your timelines. Because you said, well, yeah, it takes years. And that sucks, right? If you see the amount of money that's in your account fall by 6 7 figures, that hurts. But if since you started you said all of this is for when I turn 65 and you're in your 20s 30s 40s even 50s, then yeah, it takes years, should be no big deal because you're not counting on that money for anything over the next decade plus. But that is not human nature. Like, you need to ensconce yourself in a community that also thinks that way because if you don't, then you're going to panic.
Yeah, and this, by the way, is exactly the problem with FinTwit. It's like, all right, so if you don't need the money tomorrow or next month or in a year or in 3 years or 5 years, why the hell do you care if something's going through a drawdown? If nothing has changed fundamentally, and if you don't need that capital, if you don't need that liquidity, and that goes to your point, Brian, about living well below your means, right? None of that matters. I mean, it's when people get stuck in high fixed cost living where the drawdown hurts them, which then impacts their longer term performance.
Exactly. Yep, exactly.
The I wonder if, and this is kind of a thesis of mine also for a little bit of time here. I wonder if short termism being at an all time high, and I say that because you can see that with day trading and Robinhood and retail influx. I wonder if that makes longer term investing in some ways easier because there's more noise than ever before and fewer players really holding on to begin with, which you can argue makes the pot or the expected payout on betting on that longer term pot higher.
Yeah, I've actually believed that for quite a while. Um, well, and it is especially makes it a more beneficial outlook during the times kind of that we've been in since I would say November 2021, where things are crashing everywhere. And if you have a disciplined approach and you are regularly putting money into the market, the thing is that you shouldn't count on that showing up in your portfolio for at least 3 to 5 years. And again, for 99.9% of human history on Earth, such an outlook would have been fatal to take because you need to survive from day to day. But if you're talking about investing in portfolios, that's much more like trying to grow a sequoia. Like, it's not going to happen overnight. You need to give yourself enough time for that to show up. And so, yeah, I think that we will look back in 2028 and say, man, 2023 was a great time to invest with the short termism, with all the individual investors pouring into the market, especially during the pandemic. It did create a bubble. I think we've seen that, but now that it's crashing, it's the same effect, just in the other direction.
After a year like last year, are there new stocks or new areas that you yourself started focusing more on that are not in your portfolio? I mean, when you have such a bizarre decline like what happened last year, and I say bizarre because of the sequence and the way it played out and the failure of the flight to safety trade and all this stuff. Um, what are some of the things that you're paying attention to now? The best investments tend to be when you buy dislocations. I'd argue there's a ton of dislocations here.
You know, I look very much at individual companies, but I naturally tend towards software as a service type companies, just because I believe that there are certain factors at play that do add to a moat. Like, for instance, Axon Enterprise, they police body cameras and software systems. I believe that that has an enormous moat. I mean, try and switch over your police department using the software that they have to store that. That is a huge task. And the optionality that software companies have of rolling out new products, that is a lot easier sell than a lot of other things. Like, look at how many times Chipotle has tried to roll out a new concept and it's fallen flat on its face. It's so much harder to do in certain industries. But your question was, is if there's an area that I'm looking at. And I would say that one that I'm looking at, even though it's done very well actually over the past year, is medical devices, because once those devices start to be accepted, um, those same moats are in place where you've got doctors and hospital staff that are really committed to using a certain product, and you can start to roll out different variations for different illnesses or different injuries or different treatments, and that can really play a role. And right now, Intuitive Surgical is the only company that I have in my own portfolio that is a medical device company, and I think it's worth myself devoting time to that industry. Because the other thing is that it's relatively, the business, maybe not the stocks, but the businesses are relatively immune to the macro climate, because if you need a operation on something, it doesn't really matter what the macro climate is.
What about areas to avoid? I mean, did anything happen last year that would have affected sort of the longer term outlook? And the most obvious link there would be around higher rates, higher for longer, all this. Did last year change anything in terms of your very long term outlook with your existing portfolio?
Things to avoid, I would say the thing that I've really zeroed in on is, in my framework, there is one part of it that I didn't mention, which is, it used to be concentration risk. And that was very company specific, where, I don't want to invest in companies that count on one customer for, say, 30, 40, 50% of their revenue. I mean, we've seen it happen with Apple suppliers, where Apple will make a decision to either bring something in house or something like that, or switch providers, and overnight the company is bankrupt. I think that the same thing can be at play macro wise, but now what I've said is, instead of a concentration risk, I call it a single point of failure risk. And that has me looking anew at companies. So I'll give you two examples. Upstart. Um, they're trying to basically create the new FICO, the better way of evaluating risk for lending. Uh, and they had a single point of failure, and their single point of failure was rates. If rates go up, then they're kind of screwed. And we've seen that play out. But there are other ones as well. Like, for instance, I think Coinbase, if you overlay Coinbase's results, their net income and their stock movement, and you overlay that with the price of Bitcoin, um, those are pretty closely correlated. And that, to me, is like a single point of failure. So I wish I could give you more examples of areas where this has popped up, but I think that single point of failure is a pretty significant one. Now, if you're a beginning investor, you can even look at things like the price of oil as a single point of failure risk. I mean, Exxon in 2020 was taking on debt to pay a dividend, and it didn't look pretty there for a while. But if you're an expert in oil and you at least have a lot of experience in that industry, you are able to understand the dynamics at play enough so that it can be a smart move. And the same could be said for Coinbase. If you are somehow an expert at crypto and you believe that you can navigate that, then fine. But if you're an individual investor, you need to identify what those single points of failure are, because there are some industries that have that. Again, I think the airline industry is a phenomenal example of single points of failure that have been largely ignored. Now, you could argue, okay, well, we never had a September 11th before, and we haven't had a pandemic in over 100 years. Sure, but we've now had two instances in the past 25 years where without government intervention, these industries would have gone bankrupt. And oh, by the way, many of them went bankrupt in between those two things. So I think that's the mental model I'm taking a new look at industries with.
I shared at the top of the nest your pin tweet about most necessary skills in finance, how to analyze balance sheets, income statements, cash flow statements. What do you think is the most underappreciated metric when it comes to fundamental valuation that investors should pay more attention to, or perhaps the most attention to?
Yeah, I think that earnings, net income, earnings per share, it is slowly becoming very useless for a lot of companies. And I think that the biggest reason for this is because you now have to account for your investment results. So, for instance, Amazon's earnings per share is wildly skewed by what happens to Rivian because they made an investment in Rivian. Now, that doesn't reflect the underlying business of Amazon one bit. That doesn't reflect their core, their ability to generate cash one bit. And more experienced investors do know this, so I'm not saying anything new. But if you're a beginning investor, I think the PE ratio and earnings in general does not mean very much. I think free cash flow, and a lot of people say, yeah, but free cash flow, it doesn't account for stock-based compensation. Then I would say, if you want to look at one thing, look at free cash flow per share. Because free cash flow is actual cash. That's cash accounting. Earnings, that's accrual accounting. That's philosophical cash. It is not actual cash. Free cash flow is actual cash. And if you want to account for that stock-based compensation, do free cash flow per share, because then you're leaving room for that stock-based compensation as well. If I just had to pick one, that would be the one that I would say to focus on.
And that also keeps you out of a lot of trouble, right? I mean, you're not going to have a so-called zombie company having free cash flow.
Right, exactly. Do you know why the free cash flow statement ended up having to be regulated to be submitted? Because I think it's a great story. I'm putting you on the spot
No,
here.
I actually
Sorry for
don't.
that.
No, no, please.
It was because of Enron.
Mm.
Now, Enron, the way that Enron accounted for its revenues, it would count revenues for things that would not be collected until far into the future. This isn't that different than what happened, by the way, with Solar City. And one of the reasons that Solar City ended up not working out and has not worked out well for Tesla either is because it was based on all of these revenues that would be collected into the future. Well, if Enron was forced to submit a cash flow statement, you'd have seen that, okay, that's great. I'm glad that you think you're going to collect all this cash in the future, but how are you going to pay your bills tomorrow? And, they weren't able to. That's why they went belly up. So I think that will keep you out of trouble if you keep your eye, because the cash flow statement, even though it's messy, much more closely reflects how a normal human being thinks about their finances. They want to know how much cash they have in the bank at the end of the month. They want to know whether they lost or gained cash during the month. And the income statement actually doesn't tell you that, because it's got depreciation and amortization, and it's got non-cash charges, which all have their place. Don't get me wrong. But if you don't understand the difference between an income statement and a cash flow statement, you might end up thinking that they mean the same thing, and they don't.
Well, I'll take it a step further. I think people think that they look at a chart and they think that that means it's a good company. Just a price
Yes.
chart, right? There's a bigger issue at hand in today's society where people are just not spending the time and actually doing real due diligence. They're simply going to some favorite charting software and then overlaying a couple of indicators that you can't even really backtest to see if they're valid, and that is their justification for buying something.
Yeah, I mean, look, we like finding shortcuts, and I think that that's okay. And we learn by making mistakes. And I think if you're a financial educator, what your job is to help people make inexpensive mistakes. Because I learned the difference between cash flow statement and net income because I made mistakes. I learned the lessons about valuation because I made mistakes. I didn't pay any attention to valuation, and I think that contributed to a much larger drawdown than I needed to have. Now, by how much? I have no idea. But if I was down 30%, it wouldn't have raised a yellow flag. That's why I'm willing to talk about how big my drawdowns were, because it will help other people make less expensive mistakes than I just made. And that's kind of our job, right? Is to help others learn by making mistakes, but don't lose the whole boat making your mistakes.
It's also intellectually honest. I mean, it drives me crazy to no end the people that talk about a particular trade that they made that worked, or a particular time period where their analysis was right, and they keep beating their chest around that. And one, you can't even validate their performance, but it's a disservice to followers if you're only if you're only cherry picking the times that you performed really well. I mean, the reality is you learn more from your losses than your wins.
Yes, absolutely. And that's why you should look for people that share you got to look. I love people say people that are wise, like Nassim Taleb says, I want to go to the doctor that says I don't know to something, because if he or she doesn't, then they're probably bullshitting me at somewhere along the line. And same thing if you're looking for advice, with finances, find someone who's willing to talk about when they lost a ton of money, because at least then you've got someone who's not just feeding you a line.
I think that's a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Brian Stoffel. Stay tuned for noon Eastern, where I'm going to be interviewing Kevin Bambro. And everybody, thank you for joining. I appreciate you, Brian.
All right. Thanks so much.
All right. Cheers, everybody.